Welcome to Looking at the Markets with David Modell. Today's topic is make money in stocks and options with the 8-day EMA. Does this really work? Well, let's talk about that. First, a review of moving averages. What is a moving average? Well, a moving average is a type of momentum indicator, meaning that it tells you whether the price of a stock, and it doesn't have to be a stock, it could be an ETF, option, commodity, currency, etc. Tells you whether it's trending up or down or sideways. Now, there are two types of moving averages that people often use. First one is a simple moving average, or SMA. That is simply an average of the recent prices of a stock. Now, an exponential moving average, or EMA, is a weighted average that gives more weight or mathematical importance to recent prices than to older prices. An SMA might be considered more of a true or smoothed out average of the given period of time because it gives an equal representation of the entire period of time. So for example, a 20-day SMA gives equal weight to all 20 of the days that it's measuring or averaging. On the other hand, an EMA will react or turn sooner than an SMA when price changes occur. And I'll show you what that means right now. In this daily candlestick chart, and this is a Nike stock chart, we can see how the EMA has greater sensitivity and appears to turn or react sooner than the SMA when large price swings occur. So let me show you how the EMA is a little bit more reactive, and it just seems to react, or the price turns quicker than the SMA. All right, so we can see Nike stock had a large downturn and then turned right around and had a large upturn. So in this case, the blue line is the simple moving average, and the red line is the exponential moving average. And we can see that when Nike turned around and went up, the EMA turned around and went up faster than the simple moving average, the SMA, which was slower to turn around and start going up. So people who prefer the EMA might argue that it reacts quicker. They want something that's going to turn faster. Here's another example. Nike turned around and went down in price. And so, again, the EMA turned sooner, turned quicker. The SMA took a little bit longer to turn around. And again, Nike went up, and the EMA started going up, turned around and started going up sooner than the SMA. And it did it again here. The EMA turned sooner than the SMA. Now, I've heard a number of people claim that the 8 EMA, or 8-day exponential moving average, is a highly reliable short-term momentum indicator for stock and option traders. Some people will assert that the 8 EMA is highly predictive and a real moneymaker. Now, I'm skeptical of anybody who claims to be able to predict where stock prices are headed in the short term, so I wanted to examine the supposedly magical 8 EMA. So let's see what I came up with. Now, this is what they're claiming. The claim is this: if a candle closes below the 8-day EMA, that's a bearish signal, and we can expect the price to fall further. If a candle closes above the 8-day EMA, that's a bullish signal, and we can expect the price to rise further. And here's an example. Here's just a random example that seems to work that way. All right. You see and this is a daily candlestick chart of just a random stock that I chose. Doesn't matter what stock it is. It's just an example. We can see that this candle closed below the 8-day EMA. And, well, look at that. Afterward, it went down. So it seems that they're right in this case. And then now we have a candle that closed above the 8-day EMA. And look at that. It went upward afterwards. So, hey, maybe there's something to this. Let's see. Looking at some randomly chosen examples, I came to a few conclusions. First, the daily candlesticks all seem to crowd very closely around the 8-day EMA. The candles go above and below the 8 EMA very frequently, sometimes barely closing above or below the line. Thus, the above and below signals aren't as clear as we might expect them to be. Secondly, the 8 EMA is not very helpful in predicting where a stock price will go during an earnings report. And third, it's not unusual for a candle to close above the 8 EMA, but then go up after that, or to close above the 8 EMA, but then go down after that, thus contradicting the claim that the 8-day EMA can predict future price action. So as I said, I chose some random examples, and this is not a scientific study. You'd have to back test this much more thoroughly. But let's take a look at a few examples just to show you what I discovered. Here's Gilead Sciences. I just chose these stocks at random. And as we can see, the 8-day exponential moving average oftentimes will hug the candlesticks, or the candlesticks will hug the 8-day EMA. You'll have a whole bunch of candles right on top of the EMA, right on top of the line there. And so that could be very confusing. How do you know what to do during this time? Okay. And also you can run up a lot of commission costs this way, because here it is closing, it's closing below the line, and then the next day above. Okay. And then here it is closing below, and then closing above, and then closing below a couple days later, then closing above a couple days later, then closing below a couple days later, and then above. Imagine the fees and commission costs you're going to rack up during this period when the candlesticks are right on top of the line. They're hugging the line there. All right. So I don't know if you want to trade that often. And the price went nowhere really during this time. And so you'd be running up all these commission costs without making any substantial profit from the price action. All right. Now, sometimes it works. We can see here this candlestick clearly closed above the line. And the claim is that it would be bullish and go up after that. And look at that. It went up substantially after that. Of course, you'd have to have a lot of conviction and a lot of faith to hang on for this long. I think a lot of people would have taken profits after this little run up here, and then they saw the price start to go down. Okay, but if you held on, yeah, you would have made a decent profit. Now, I did mention how This method cannot reliably, in my opinion, be used to predict earnings reports. All right. So here's a big drop after an earnings report. And I don't think this closing above or below the 8-day EMA method would really have predicted this. So if you're going to use this method, I would definitely close out your position, if possible, before a big event is expected, such as an earnings report. For example, over here, we've got a candle closing clearly above the line here, and yet, then we have an earnings report and boom, way down. So you definitely would have lost some money there. So if you had closed out your position before this earnings report, that might have been a good policy. Also keep in mind, big events like the Brexit event or whatever, this closing above or below the 8-day EMA method would not safeguard you necessarily against, major catastrophic events or major surprise events. All right. So it seems to work sometimes, but not others. We can see it. Yeah, it kind of works here. I mean, it closed above the line and then went up. Okay. It closed below the line and then went down. All right. So you could have some faith in this method if you want to, although it just doesn't seem consistent enough for me to want to use. I picked another random stock here, Coca-Cola, very popular one. And does it work? Well, again, you've got a lot of crowding, a lot of times when the candlesticks hug the line here, and so it's closing below, then the next day above, then the next day below, then the next day above and below and above. And you're not going to make a whole lot of profit here on the price action, and you're going to run up a lot of commission costs if you adhere to this method. All right. Now here's an example where it closed above the line, and so you, according to this method, you were supposed to buy here, or it was supposed to be bullish, and then boom, went way down. And again, it doesn't safeguard against unexpected events like Brexit or earnings reports. Here's an earnings event, and boom, went way down. Here, another earnings event, and it closed above the line, so you were supposed to be bullish here, supposed to buy here, and boom, way down. You would have lost money there for sure. Okay, or here's a big candle down, so you were supposed to be bearish here, but then what happens? Turns around and has a big run up. So doesn't always work. Here's Twitter. Now here it worked a few times. Okay, here's a big candle that closed above, and yes, there was a sizable run up after that. So the method worked here if you had the faith and the conviction to hang on, and that's another issue entirely. Just because you have a big run up, in hindsight, doesn't mean that everybody would have had the conviction to hold on for all that. I think a lot of people would have taken profits here or here or here. Everything is clear in hindsight. Here it closed below the candle, and yes, it went down. So yeah, sometimes it works. Other times, not so much. Here's a candle closing above the line, and you were supposed to buy or go bullish here, and an earnings report, bam, you would have gotten hit pretty badly here. And there are lesser examples. Here it closed below, and yeah, then it went down, but then it went way up. So if you held on, then you might not have done so well. Here it closed below, but then it went way up. All right, closed below the line, but then up and up and up and up. And so if you had gone short here, or, yeah, if you had shorted here, then you would have lost and held on, then you would have lost money. Or if you just sold your position here, then you would have missed out on a big run up. And so it doesn't always work so well. All right, here's an earnings report, and it closed, here we are closed above the line. And so you're supposed to go long, and it went up a little bit, and then bam, big down day. So I don't see consistent predictability here. Here's Apple, another stock I just chose to look at, and here it seems to have worked here. It closed barely below the line, and that's another issue. So sometimes it barely closes below or above the line, and that's not a very clear signal. Should I go bearish when it's just kind of, right on the line but a little bit below? But then, yeah, you had a big down move. Again, an earnings report. Can this method predict an earnings report? I don't think so. Seems to work sometimes. This candle closed above, and then there was a big run up. But doesn't always work. I mean, this candle closed below, but then it went up. All right. This candle closed above, but then big down move. So I just don't see it necessarily working. And again, an earnings event here, it closed below, but then earnings brought it way up. And so if you had gone short here, you would have gotten hurt if you had held on. So the takeaway is that personally, I wouldn't use the 8-day exponential moving average as a buy above, sell below signal. Instead, I view it as I view any moving average, a potentially useful tool for assessing the general trend of a stock price. And if you'd like some help with this, with technical indicators, moving averages, reading charts, or just stocks and options, trading and investing in general, feel free to contact me. My name is David Modell, spelled M-O-A-D-E-L, and my email address is davidmodell@gmail.com. Thank you so much. I hope this was helpful, and I hope to hear from you soon.